Welcome to the Private Lenders Podcast with your hosts from Hard Money Bankers, Jason Balin and Chris Haddon. This podcast is sponsored by hardmoneymastermind.com.
Hey everyone, thanks for checking out the show, Private Lenders Podcast. We do appreciate it. Wherever you are watching or listening to this, if you could do us a small favor and give us a subscribe or a follow or a like, that would be really, really appreciated. Okay, today we're talking about a fund versus a co-lending model. We're going to break down what they mean, pros and cons, and real quick spoiler alert, there's not 100%, there's no way to say that one is 100% better than the other. Right? Based on the situation, based on the person, we're going to break down pros and cons, and hopefully you can take some of this information and apply it to your lending business. Because frankly, this is a really common question, both in the inner circle and the online mastermind.
Yeah, I was going to say inside the inner circle, inside the mastermind group, it comes up kind of once a week of what's best for me. What do you do in this situation? And thinking about, the 30 lenders that are in the inner circle group, shout out to inner circle members. Just
I got the new t-shirt on.
Got the new Tampa, Florida. We're all meeting up 2 weeks today, right? As we're recording it. So we got plenty of swag for everybody who's hopping in. If you're not in for this event and you want to apply, just go to hardmoneymastermindinnercircle.com. And if there's any openings for the May 2025 event, I will let you know. Anyways, I was thinking about that group because when we started the group, years ago, there's probably only one person that had a fund. And now I would say there's three types. A third of the lenders in there do co-lending, just like we do. A third use a fund. The other third are, individual investors that are just, they only lend their own money. They don't raise other capital. So they just self-fund and they're trying to responsibly do that. But a lot of people are doing the fund model. And I think there's pros, like you said, Chris, I think there's pros and cons of both. We've only done the co-lending model. I don't want to say it's all we know, but it's all we've done over the last 17 years. And it's worked great for us. Honestly, I don't know when we started if raising a fund was even an option for us or a good option for us. I know for a fact that a lot of the private capital investors that came on board early on, they probably wouldn't have come on board with us if it was a fund. They like the transparency of the co-lending model and being attached to each individual deal. So how do you want to start this? Should we talk about pros and cons of each?
Let me do a quick definition of each first, and then we'll jump into some pros and cons. So a definition of co-lending is the idea being that in the states where we operate, anyone can be a commercial lender. There's no license to do so. Jason can be one, I can be one, our uncle can be one, our business entity can be one, right? So the co-lending, and a quick breakdown of that, is when you fund a loan in your company's name, Hard Money Bankers LLC, in our name, and then I'm going to assign it immediately at the same time as closing to Jason Balin and Chris Haddon, to ourselves. We're going to split that loan. It's going to get recorded in public record, Hard Money Bankers LLC. We're going to take the original assignment document, sign it, notarize it, send it to our attorney's office for safekeeping. And us and any of our co-lenders, our capital investors, know that they have access to that document if they ever need it, and they probably never will. And then we service everything. Payments come every month. We're paying out a 10% return to the investors. The company's keeping a 2.99% servicing fee, and on it goes. And so you can have one loan per, or one lender per loan, 2, 3, 4. I try not to go any higher than that just because it gets a little clunky. But that's the definition of co-lending. Now, a fund is the other thing. And mind you, like the opinions that you get from lawyers are going to trip you up a little bit, because some are going to look at your business model of co-lending and say, yep, that all makes sense. That seems to check out. And then other attorneys, and this kind of depends on what their focus is as an attorney, what their area of practice is going to say, no, you can't do that. That sounds like selling securities. You're going to need to get a registered fund. And so a fund, and granted, there's a few different types of them. We are not experts. We have not operated our own fund, but being in this business and working with people and knowing about stuff, we do know the basics. So a fund is when you draw up a private placement memorandum and you outline what your business is going to do. We're going to lend on investment real estate, both investment residential and small commercial in these states, in these loan amounts, and so on and so forth. basically your business plan, right? And then you have a subscription agreement and some other documents where investors sign up and say, okay, I'm going to give you $500,000 and expect these repayment terms. Like I guess we should focus on the basics of a debt fund, since that seems to be what most lenders are doing. And so long story short, their funds go into the fund, they're $500K, and then you're going to pay them probably quarterly. Sooner, more often would be better, but from what we hear, it's typically quarterly. They do not see deal to deal. They only get like periodic updates from the company of any news, how the company's doing, annual report, whatever it might be, and they get their rate of return. Otherwise, they don't get too much news or information, and on it goes. That's the definition. A little long-winded, but I wanted to get those two out before we jump into pros and cons.
Yeah. And again, we're not attorneys, finance experts, or CPAs. We're just telling you how, we've done it inside our operation. So make sure you obviously check with legal counsel. Yeah. The important part about checking with legal counsel in general is making sure they understand this business model, right? A lot of folks will chat with their local attorney that they know, and they'll be like, oh yeah, you can't do a deal like that because you're under usury, or you don't have a license, or you don't have this. Well, remember, it's a commercial purpose transaction. And if you go back to one of the podcast episodes that we interviewed Kevin Kim from Garassi Law Firm, he discusses some of that. And there certainly are some licenses to get in certain states. And if you need to get that license, you get that license, right? But sometimes there's not licenses to get. So you can't get one because there's not one that exists. So all of that stuff, definitely check out. I think his firm is a good resource for that, because that's what they practice, right? Yeah, anyone who's practicing private lending on a regular basis, discuss the way that you're trying to structure things and see the best way in order for them to help you, ease your mind on how to structure it. But regardless, take that part of it out of it. Pros and cons of kind of the co-lending and raising a fund. And there certainly are. So let's just talk about some co-lending stuff. I'll just spit out a few that I believe, and then Chris will jump in with some that I might miss. Number one, there's no real cost to the co-lending model, right? You don't really have to, have subscription agreements or anything. Nothing really needs to be set up. You have whatever, dad has $100,000, call it. And you want to do a deal. You can close the deal under your name, assign him the deal for $100,000, retain servicing, keep the points, servicing fees like that. If that's how you see fit, right? And obviously you want to service the loan and make sure you can account for it properly. When you're just starting out, typically Excel spreadsheet and QuickBooks. As you grow, you want something more elaborate, like the Mortgage Office or Mortgage Automator as a servicing software. The lender's actually attached to the loan, right, after you assign it to them. So in essence, they're the first position lender intact. And, that's good and bad, I suppose. It's good for most people because it's like, hey, like, I'm the first lien holder on this property. Like, this is mine. I control it, for better or worse, right? I'm not, bundled in with lots and lots of different investors, and I'm not sure what the money's getting used for or not. Like, this is exactly what the money's going for, and I'm using my capital just for this in order to do so. That's a pro and a con. The pro obviously is, you know exactly what you're investing in. The con is if the deal really goes sideways, you're not getting bundled in with other investors like in a fund, right? It's you or it's them, I should say, that's taking the risk. There's obviously a lot of flexibility, right? You can determine what deals you want to do, what deals you don't want to do, with that capital investor. I remember back in the day, we ran into a few big lenders that had funds, and, however the fund was set up, they had to do loans that met that fund exactly. They couldn't do creative deals, even if they wanted to. What else are some big benefits of co-lending?
So I think a benefit of co-lending is, let's just go with the pro and the con of this part. The investor relations aspect and ongoing capital raising, I believe, is more effective in co-lending because of the amount of communication that you're having with your investors. So if you if you get 500 grand from an investor and it goes into the fund and you're going to put it out into deals, you're not going to talk to this investor that much. You're not communicating with them deal to deal. And granted, some people do want to talk about deals, some don't. And also they're not going to have that constant servicing and, in essence, money being paid to them that you have in a co-lending model. So using the mortgage office and co-lending like we do, we're paying people every week. So we're pinging people with money and a statement by email and electronic payments every week. And when you're in a bunch of deals, you're getting paid on a number of things every week. And that high frequency of communication is an awesome tool for raising capital. As you communicate this much with capital investors, they will bring more money your way. They will refer people to you. And the opposite is also the case. So in a fund, you're not going to communicate with them that much. There's not going to be the opportunities to discuss deals and raise more money. But at the same time, that also becomes a pro of a fund in that you don't have to do all this back and forth in order to fund a deal. You already have the money in your fund. It makes that part of investor relations, that transactional work back and forth. There really are pros and cons. Like, one, it's a bunch of work. Number two, you're going to raise money from doing it. Right?
Yeah. No, I think that's important. And I think, there's no secret sauce to raising capital. We've had videos and podcasts that we've done relating to, how we've had success with raising capital from investors over the years. But our biggest hack, and this didn't mean to happen like this, our biggest hack was just keep paying our investors as much as possible over and over and over, and communicating with them about investments or about their deals. And keep
TMO told us that was going to happen. AJ told us that was going to happen.
Yep.
And he's right.
Yeah. Like, that's what it is. And, so even if you're using a fund, that doesn't mean you can't do it that way. But I'll give you an example. So our buddy Ian, that I think a lot of folks know, not our business partner Ian in our lending company, but our buddy Ian, who we do a podcast with, who we've invested in a lot of his syndications, and we own real estate with him, and we've done some commercial warehouse, office deals, self-storage with him. So he does, in essence, he raises capital as equity, and he pays quarterly distributions. And one of the things we told him early on, because he's always raising capital. Commercial investors are typically always raising capital for ongoing deals. And we're like, listen, like, you're doing quarterly distributions. I know that's standard in the market, but like, get your books reconciled and do them quicker. Spend the time to do them quicker.
Do them more often.
And do them more often, because instead of you're picking an investor 4 times a year, maybe four times a year with money, then one time with a report or something, end of year, you send them an email with a K1 and some other stuff. And that's all great. For investors that are involved in a lot of deals with us, dude, we're pinging them freaking 4, 5, 6 times a month. If they're getting paid every, if they're in a lot of deals, and in essence, they're getting paid on a weekly basis, or every, as loans are getting paid, they're getting ACH notifications, wires, ACH notifications, wires, lender reports, like, oh, you're in a new deal reports. Like, they could literally get hit 10 times a month with positive news. Loan paid off, new loan there, things like that. So
we're pinging them like 75 times a year, call it.
Yeah.
Between reports and payments and all that stuff, as opposed to like 4 or 5. Yeah.
And I mean, that prevents us from having to do, ongoing meetings, lunches, happy hours, things like that. Like, it's a raising capital machine, just setting it up that you're paying your investors on a regular basis. So again, point being is, that's if it's co-lending. If you're raising a fund model and you're looking to raise more money, I would encourage you to do something similar to that.
Like, step up the level of communication, even though it's not required by the fund model.
Yeah. Maybe it's exactly. Maybe every closed loan, maybe this, maybe that. I'm not sure, because we don't have a fund, but I'm thinking out loud. Just make sure you're reaching out to them on a regular basis to show the performance of the fund and how well it's doing. And, oh, you got more money and you got this, and it goes a long way to raise capital. So I think all in all, both models are great. One thing that Chris and I talk about inside, inner circle members that ask us about stuff is, if you're at like a $10 million or higher portfolio, I think you can absorb the costs that it potentially makes sense if you want to on the raising fund. I mean,
the legal and accounting costs and all that stuff.
Yeah, I mean, I don't think we would ever change anything. I mean, we have a pretty well-oiled machine. We like the way that we're doing it, and it works fine. I also don't know how I feel about potentially being responsible for making sure the fund payments were made, even if we weren't collecting the money from a deal. We can go through that.
I wanted to bring that up in a sec.
Yeah, go ahead.
Should I go now on that? Okay. So some things that we don't 100% know because we haven't operated a fund, even though we know what goes into the documents, like we know what people say, what's written into them. But how does that work? Like if you have a quarterly payment due, and I think these debt funds will have some kind of hurdle rate, like say they have to pay out 9% or whatever the number might be. And so do they have to hit that number every quarter? Is that how that works? Yeah, that's kind of my understanding. So like we're going to have some more people talking about funds at the Inner Circle meeting, but say you have to pay out a 9% on your whole fund. And is that includes money on the sidelines? If you have money in cash, like those people are expecting a return too, right? Those people are expecting a return, whether it's, say you have 10 million deployed and 3 million on the sideline. You have to send out a quarterly payment for all of it, is my understanding. And like Jason said, what if you have, 10 people who are behind on their payments? Are you coming out of pocket to hit your hurdle? How does that work? That's kind of my understanding. And it sounds a little scary because, we've been lenders for a long time. We know that not everyone makes their payments on time. In fact, in this line of business, in this line of work, this kind of lending, people miss payments all the time. An active part of we had a default meeting today, and an active part of our operation month in and month out is chasing people around for payments daily, a matter of fact. So yeah, I don't know 100% how that works. I'd like to get a little more. I know that some of the people in the Inner Circle who are running funds are earlier on, like they're a quarter or two into raising and running a fund and lending out of it. And this kind of stuff we're going to continue to talk about. Definitely in the Inner Circle and the online mastermind, because members are going to get more experienced with this stuff and be able to offer more insight to other lenders. Guys, this is exactly why we have the mastermind group, both the online and the Inner Circle, is so that we can all learn together. Definitely the point. Anything else to add on either co-lending or fund stuff before we wrap up?
No, I mean, I think just, think about it. Think about the way that you're going to do it. I mean, the good part is you can always start with co-lending and then work your way to raising a fund. I mean, we know some lenders that take unsecured debt or they sign based on behalf of their entity, and then they have that and, lend it out as needed. There's lots of different ways to accomplish it, and it shouldn't prevent you from starting the business, obviously, but start with, what works. Keep it simple and then work your way up. And
you could also dive in with a fund and just operate that alone, and you won't know any different. So it won't seem any better or worse on the other side of things. So anyway, as we learn more, we will come back at you with whatever we got. Appreciate you checking out the show. Like I mentioned, please do give us a subscribe wherever you're watching or listening to this, and we'll pop up in your feed next time. And we'll see you here next time. Private Lenders Podcast. Peace.
We hope you enjoyed this episode of the Private Lenders Podcast. Please note that the opinions stated by all the speakers on this show are only opinions and not intended for legal, financial, or accounting advice. Please make sure to always check with your own legal, accounting, and financial professionals. If you enjoyed this episode of the Private Lenders Podcast, we'd appreciate it if you would spread the word. Make sure to check out hardmoneymastermind.com, the #1 free community for new and experienced private and hard money lenders.